Have you been wondering how to make your money work so hard it starts generating wealth while you sit back, sip on a coffee, and live life on your terms? Sounds great, right? But wait, you don't know where to start. The stock market looks like this terrifying roller coaster where you hop in, scream, and lose all your money. I get it, it's overwhelming, and with every other platform throwing around investment jargon like beta, hedge, or whatever other financial mumbo jumbo, who wouldn't feel lost? But what if I told you you could actually get rich by investing in just 3 ETFs which will diversify your portfolio just like a Wall Street investor? That's right, but before I simplify investing for you, why don't you simplify your subscription list? Go ahead and hit the subscribe button because trust me, it's the easiest investment you will make today. And I promise a 100% guaranteed return in form of value-packed content. I mean, you can't put a price tag on knowledge, right? Okay, you technically can, but I'm not charging you a penny for this. And one more thing, I'm not a financial advisor and this video is not an investment recommendation. I'm here to educate and share simplified strategies based on what has worked for me and thousands of other investors. Alright, let's just get started now. First, you need to understand the goal of your investing. It's about building long-term wealth. The stock market isn't a put your money in today and get rich tomorrow scheme. And if anyone's promising that, it's most likely a scam with a flashy website and a guy or maybe a girl in a rented Lamborghini. So be aware and don't just go and buy some random shitcoins. Investing is not about getting rich fast, it's about getting rich surely. The key word here is long term. Now here's a fact, if you keep all your money sitting in a savings account, you're actually losing money every single year. Why? Because of inflation, which averages around 2.5 to 3% annually. And your money doesn't even get like 1% in your bank account. So to beat inflation and grow your wealth over time, you need to invest in assets. How you allocate your money depends on your risk profile. For example, if you're young, let's say around 25, you can take more risk and invest heavily in stock market because you have time to recover from any losses. As you get older, you should rebalance your portfolio by including safer, more stable assets like bond, debt funds, or real estate. Although I'm not entirely sure how reliable real estate is anymore because, have you seen the housing market lately? It's just insane. I've already made a video about 15 assets that are making people rich. You can check it out. I'll link it here in the description or in the corner. You can just check it out. So let's jump into the first ETF, a broad market ETF. A broad market ETF, as the name suggests, tracks the performance of a large and diverse market index. This allows your money to be spread across a broad range of companies, making it one of the safest and easiest ways to start your investing journey. To understand this better, S&P 500 Index Fund ETF. These track the top 500 companies in the US. Then we have total stock market ETFs. These include all the companies listed on the stock market. When you invest in these ETFs, your investment is diversified across all sectors, reducing risk and balancing your portfolio. These funds have historically delivered a 10% average annual returns, or about 7% after adjusting for inflation. If I had to pick just one ETF to start my investing journey, it would come from this category because it offers a combination of safety, ease, and solid long-term returns. So here are top ETFs to consider from this category. You can literally pick any one of these. They have almost identical returns. Vanguard S&P 500 ETF or VOO. It has lower management fees, making it more cost efficient. It's managed by Vanguard, one of the 2 largest investment firms in the world with about $8 trillion in assets under management. Next is SPDR S&P 500 ETF or SPY. This is the oldest and largest ETF in the US, managed by State Street Global Advisors. Although slightly more expensive than VOO, its management fees is still extremely low at 0.09%. That's just 90 cents per $1,000 invested per year. Both VOO and SPY do exactly the same thing. They track the performance of S&P 500. If you're stuck deciding, just go with either one. For Canadian investors like me, we have VFV, which is literally the Canadian version of VOO. This ETF is traded in Canadian currency, helping you save on conversion fees. Personally, I started with VOO, but later switched to VFV for this very reason. Next, we have Total Stock Market Index ETF. We have VTI, which is Vanguard Total Stock Market Index ETF. This ETF gives you exposure to almost every company listed in the US stock market. It's cost effective and ideal for maximum diversification. And again, for Canadian investors like me, we have VUN, which is literally the Canadian version of VTI. traded in Canadian currency to save you on fees. So if your goal is to diversify across all the companies, go with VTI. If you want to stick with the top 500 companies, choose VOO or SPY. Over the long term, the returns of S&P 500 ETF and total stock market ETF have been almost identical, so there is no need to overthink it. Moral of the story is, don't get overwhelmed by the variety of ETFs that do the same job. Pick one, start investing, and stay consistent over the long term. That is what will make you rich. Next up, we have growth ETFs. These focus on fast-growing, expanding companies, which makes them incredibly lucrative, especially during a bull market like the one we are in right now. But here's the trade-off. They're also more volatile. Think of them like a roller coaster, thrilling when you're in for the ride, but not for the faint of heart. Now, here's why they are great for young investors. If your goal is to save and grow your money over the long term, these funds are perfect. Yes, they might drop by 20 to 30% during a crash, but if you don't need that money anytime soon, that drop is an opportunity. Stocks are basically on sale and you can buy more at discounted prices. The most popular pick in this category has to be QQQ, or its slightly newer and cheaper version QQQM. Now, both of these ETFs are managed by the same company, Invesco, and they both track the NASDAQ 100 index. This index covers 100 large non-financial companies listed on the NASDAQ. And no surprise here, it's packed with some of the biggest and most exciting names out there. Tech giants like Apple, Nvidia, Microsoft, Amazon, and Google, plus a mix of non-tech companies like Costco, Booking Holdings, and Starbucks, and many more. Here's where QQQ and QQQM differ. QQQ has a management fees of 0.2%, while QQQM offers a slightly lower fees of 0.15%. QM is just the newer version with lesser fees, which was launched probably around 4 to 5 years ago. That small difference in price might not seem like much, but over time you'll end up with a little more money in your pocket with QQQM. I'll just refer them as Q and QM to make it easier for me. So essentially they are the same ETF, but QM is a little cheaper option. Now let's talk performance. On average, this ETF has delivered a 10% annual return since its inception. But thanks to tech and AI boom in recent years, things have been a little crazy. Over the past 5 years, the NASDAQ 100 has averaged a return of around 20% annually, even after a 32% crash in 2022. But the year after, it bounced back with a massive 54% gain in 2023. That's just insane, and this year it's already up close to 30% year to date. If you're in Canada like me, you can look into XQQ. It's essentially the same ETF, but it's Canadian hedged, meaning you avoid currency conversion fees and the risk of currency fluctuations. It does compromise on the return parts a little bit, but I personally invest in XQQ because we don't have a lot of options, but in future, who knows, maybe I'll switch to QM. Now, before we move on to the next one, if you're enjoying this video so far, please hit that like button. It's just a simple click for you, but it helps me a lot to reach out to more audience. So moving on, let's talk about the last one, which is a dividend paying ETF. These are designed to invest in a basket of stocks that pay high dividends. So no matter what happens with the stock price, you'll earn a passive income on the side. This makes them a solid option for investors who are more risk averse or those who are seeking a steady income stream. One of the most popular dividend ETFs out there is Schwab US Dividend Equity ETF, or SCHD. This ETF tracks the performance of the Dow Jones US Dividend 100 Index. What does this mean? Well, it tracks the top 100 high dividend paying stocks in the US with a focus on companies that have a strong record of consistently paying dividends. These companies are also selected based on their financial strength, using key financial ratios to pick the winners. Now let's talk about the fees. The expense ratio for SCHD is just 0.06%. That means for every $1,000 you invest in this ETF, you'll only pay 60 cents in fees per year. That's pretty cheap. And as for the dividend yield, SCHD offers about 3.3% dividend yield based on the trailing 12 months. It's definitely not bad, and here's the kicker. The ETF has a compound annual growth rate of around 11% for dividends. This means that on average, the dividend yield has been increasing by about 10 to 11% per year over the last decade. And this ETF has had 13 consecutive years of dividend growth. That's some solid performance. So when you invest in SCHD, your money is spread across a range of companies, ensuring diversification within the dividend paying stock universe. This makes it a great way to earn passive income while also benefiting from long-term growth. So for anyone who just want to keep things simple and just invest in 3 ETFs without getting caught up in all the what ifs, here is a straightforward list for you. Number one is VTI for broad market exposure. Number two is QQQM for growth stocks. And number three is SCHD for stable dividend paying stocks. That's it. By adding these three ETFs to your portfolio, you'll have a well-balanced mix. You'll be diversifying across the broader stock market with VTI, tapping into aggressive growth stocks with QQQM, which comes with a little bit more risk but also high potential, and adding some stability with SCHD, which focuses on well-established, high dividend-paying companies that have been around since you and I even existed, and they still continue to perform well. If your goal is to invest for long-term, then short-term risk and market fluctuations shouldn't be a major concern. The stock market can be volatile in the short run, meaning the value of your investments may go up and down, sometimes significantly. However, when you're investing with a long-term mindset, say 10, 20, or even 30 years, these short-term swings become less important. Whenever you see these short-term dips, remember to always zoom out and look at the long-term performance. I'll leave links to all the ETFs I mentioned in this video so you can easily check them out. You can invest in these ETFs on platforms like Wealthsimple or Questrade if you're in Canada, and Robinhood, Charles Schwab, or Fidelity if you're in the US. And if you're curious about the best order to invest your money, be sure to watch this video where I'll walk you through step-by-step process. So let's dive into that and I'll see you there.